All right, let's dive into a real head-scratcher for you today. We're talking about a company, gambling.com group, that just reported its best quarter ever. I mean, they absolutely smashed expectations. Now, you'd think the stock would go to the moon, right? Well, it did the exact opposite. It took a nosedive. We're going to figure out why.
So picture this, it's August 15th. The company drops these incredible, record-breaking results. And the market's reaction? A total bloodbath. The stock didn't just dip a little, it cratered, down 17% in just one day, with a ton of trading volume. It's a total paradox. And that's what we're here to unravel.
I mean, it just doesn't add up, does it? What on earth could spook Wall Street so badly? How does fantastic, record-breaking news trigger a massive sell-off like that? That is the big puzzle we're going to solve together today. Okay, so to really get to the bottom of this mystery, we have to start with the good news. Let's really look at these incredible numbers, because on any normal day, this is the kind of stuff that should have sent the stock through the roof. First up, revenue. A record-shattering $39.6 million. That's a 30% jump from the same time last year, and it totally blew past what all the analysts were expecting. So far, so good, right? A fantastic start. And then you look at the earnings. Oh man, Wall Street was predicting maybe 12 cents per share. The company came in and delivered 37 cents. That's not just a beat, that's an absolute demolition. We're talking more than triple the forecast. The good news just keeps getting better and better.
And listen, this wasn't just some accounting trick. The actual cash the business is generating, what we call free cash flow, it surged by 36%. So by pretty much every metric you can look at, this company looks super healthy, super profitable. It's an incredible story so far.
But buried inside that record revenue, we find our first real clue. You see, while their traditional marketing business did just fine, their newer division, this thing called sports data services, it absolutely exploded. Its revenue quadrupled. And just like that, it now makes up a full quarter of their entire business. Tuck that little fact away because it's going to be really important later. So let's recap. We've got record revenue, earnings are demolished, and there's a booming new division. What on earth could possibly be the problem here? Well, to answer that, we have to look at what really spooked the market. The big, scary monster in the room was this phrase you might have heard: SEO headwinds. You know, simply put, it just means that Google changed its algorithm, and suddenly gambling.com's websites weren't showing up as high in the search results. And for a company that has historically relied on search traffic, that is a 5-alarm fire. And look, the company didn't try to hide it. Right there on their earnings call, management said it. They said, we expect a great year, but our forecast is being held back by these weaker search rankings. That single sentence sent an absolute chill down Wall Street's spine. And you can totally see why everyone got worried. All they heard was weaker guidance for the future. They started worrying about profit margins shrinking, and they got scared that this Google problem wasn't just a temporary little blip, but a long-term, maybe even existential threat. And suddenly, that amazing quarter didn't matter nearly as much as the uncertain future.
But this is where the story takes a really interesting turn. What if those fears, what if those headwinds weren't just some random problem to be solved? What if they were actually a symptom of a much bigger intentional strategy? This right here is the key to the whole puzzle.
I mean, listen to what the CEO, Charles Gillespie, said himself. He put it so plainly. He said, the company has fundamentally transformed. They are no longer just a business that lives and dies by what Google decides to do. They are actively, deliberately becoming something much bigger and way more resilient. So what does this transformation actually look like? Well, it really comes down to a 3-pronged pivot. First, they're breaking that dependency on Google by using apps, social media, and paid ads. Second, they're aggressively building that subscription data business. Yeah, the one that quadrupled. And third, they're jumping into brand new areas by buying up companies like a Las Vegas ticketing service called Spotlight.Vegas. You see, this isn't an accident. It is a planned escape from being under Google's thumb. And you have to understand, this whole pivot, it's not just about surviving the last Google update. It's about getting way ahead of the next massive shift in technology, which is a world where search itself is being completely reinvented by AI. Think about it. In this new world of AI-powered search, where you might get just one or two answers instead of a page of 10 blue links, the only thing that's going to matter is authority. The AI tools, they have to trust their sources. They're only going to point to the most reputable, the most expert brands in any given field. And that is the company's big bet for the future. The CEO's whole argument is that the 2 decades they spent mastering Google, building trusted, authoritative brands like gambling.com, have given them the exact skill set they need to win in the age of AI. They're betting that all that authority will make them a go-to source for AI-driven recommendations. And that's really the story here, isn't it? Wall Street saw a short-term problem with Google. The company, though, is playing a much longer game. They're pivoting for a future that doesn't revolve around Google at all. So it leaves us with the ultimate question. Is this just a reckless gamble that sacrifices short-term gains? Or is it a strategic masterstroke that's preparing them to dominate in the age of AI? I guess we'll just have to wait and see.